All right, amid deflation concerns clouding China's economic backdrop, Asian markets are massively discounted, according to our next guest. But are they too cheap to ignore? Kristen Bitterly, Citi Global Wealth Head of North American Investments, is back with us. And so, is it too cheap to ignore right now? I mean, there's certainly been a lot of focus more internationally this year. Of course, outside of China, Warren Buffett has been very vocal about Japan even recently. And so where are there some of those opportunities that exist?
Yeah, so I think the China story, obviously, this is one of the disappointing stories. I think we came into 2023 with a lot of optimism in terms of the China reopening and where we would see the benefit, because there was $2 trillion of excess savings really locked up within the Chinese economy. I think what we've seen in reality, though, is the beneficiaries of that are Greater Asia. So Japanese equities have actually performed really well, Indian equities as well. And so I think in terms of investing in Asia, it really is a diversification story. We have exposure in our portfolios, certainly to China, but we also have exposure to Indonesia, to India, looking at supply chain diversification and just some of the demographics there. So I think the China reopening at first was all eyes on kind of the A shares and the local Chinese markets, but then really looking at who were the beneficiaries. It was Greater Asia and even Europe to a certain extent in terms of consumer discretionary.
On the flip side, as China continues to sort of muddle along, and the latest story that caught our eye today that Brad flagged was a report that Saudi Arabia is continuing to get lower requests for oil from China, which implies something about demand, right? But what about the sort of contagion in the greater region? Why hasn't China sort of dragged down some of the others more?
It's a great question. I think going back to some of the comments that I made, when you look at the capital flows that have come into, obviously Japan, very different economically, and we're starting to see signs of inflation, right, in Japan, which net is actually a positive thing based on what we've seen historically. And then this whole concept of foreign capital going in from this supply chain diversification and everything that we've lived through in the pandemic, I think that's another major theme. And then there's a lot of innovation. There's a lot of innovation and demographics and addressable market in an economy like India, which is very, very distinct and separate from the Chinese economy. I will say also there's something from a consumer spending standpoint. When we look at Western economies and what happened with the reopening post-COVID, we're spending and we are continuing to spend, right, on services. You didn't see the same dynamic within China. And when you're dealing with some really, really high unemployment rates, particularly with the younger generation, I think that creates an even more cautious outlook locally.
You mentioned India, and I'm glad you brought that up because there's been a few big advancements there. Apple opening its first retail presence there in India this year. We've also seen Foxconn saying that they're going to apply for some incentives for semiconductor manufacturing as well there. So there's a lot of focus on what was the other of the two major economies that were set to really boost the global GDP, at least according to the IMF projections laid out at the start of the year. So how has India held up against some of those projections, given that much of the focus has been on China to this point?
I think the interesting thing is it's been a silent story in terms of the equity appreciation that we've seen, because so much was focused in the first half of the year on the China reopening. And so I think we mentioned Japan as well. That's also been kind of a hidden story, right? Not widely talked about. And you're talking about really significant gains within those equity markets. So I think when we're talking about international investing, this is something, and you see it within the portfolios that we manage at Citi Global Wealth, there is a substantial amount of diversification across regions, across sectors. And I think that's something in terms of looking, we talked about rolling recessions when it comes to sectors. I think there's also an element of rolling recessions when it comes to regions and jurisdictions that we anticipate to see too, which is why these types of portfolio allocations become really critical and important, and also to a large degree dynamic.
Kristen, when we have you in, when you talk about the portfolios you manage, you're talking about high net worth individuals. And I'm always curious how these folks are feeling. I mean, I assume they're less sensitive to some of the things that middle and lower income Americans are, but what are you hearing from clients right now?
So I would say the major themes, we have a couple. One, this concept of sitting it out on the sidelines. So this idea that I've lived through, zero bound rates for so long, and now all of a sudden 6-month T-bills, I can get 5.2%. Why not hang out there until something happens? I think that's a big discussion. I think the other interesting thing is it's very regionalized, even within the U.S. market. So even within the U.S. market, it's a very different story if you travel to Florida versus if you're going to Pennsylvania, for example. We were talking earlier about our Pennsylvania connections. And so I think that's an interesting dynamic too, that even within one market, we talked about the concentration of, those big mega cap names driving returns. I think you have really regionalized, like sub-regionalized dynamics where some markets feel very, very strong. Some markets are feeling the impact of, for example, the contraction that we're seeing in manufacturing.
That's really interesting. Kristen, good to see you. Thanks for coming in.
Thank you so much.
It's great. Kristen Bitterly, Citi Global Wealth, Head of North American Investments. Thank you.